And good morning and good afternoon. Welcome back to our educational webinars with SFRhub and RCN Capital. Today we've got an outstanding panel. Today we're really going to be diving into putting together the perfect, and I mean the perfect, build for rent portfolio. We've got experts from across the industry who are going to help you find ways to create that portfolio that you've been working on, not only today, but for tomorrow, and to create that generational wealth that we all are looking for. With that said, I'm going to kick it to each of our panelists to give a brief intro, and I look forward to seeing you back here in a moment. First, Mark Peterson, SFR Hub. Welcome aboard, Mark.
Thank you, Jeff. It's good to be here today. Thank you, everyone, for joining. Mark Peterson, I'm the Director of Build for Rent at SFRhub Advisors. We're a commercial brokerage based in Phoenix, but we operate nationwide, and we work with builders and investors of all sizes to help them either put together a perfect portfolio or put one together either to sell or to buy.
Appreciate that, Mark. Next up, Brad Hunter from Hunter Housing Economics. Hello, Brad.
Hey, Jeff. Hello, everybody. Brad Hunter. My company is Hunter Housing Economics. We do site-specific feasibility studies all around the country for built for rent, as well as for sale and apartments. And we look at things from the standpoint of supply and demand, and we're going to get into that in my discussion in a few minutes.
Thanks so much, Brad. Look forward to the content. Next up, Justin Parker from RCN Capital. Hey, Justin.
Hey, Jeff. Thank you, and afternoon, everyone. I'm Justin Parker. I'm the Chief Financial Officer here at RCN Capital. We're a nationwide private lender and capital provider, and our mission has really been to provide flexible and efficient capital on a nationwide level, giving real estate operators that working capital that's needed, those debt alternatives that are needed to help scale their portfolios. And that focus really spans across ground-up construction, fix and flip, transitional and rental loans, as well as multifamily projects.
Appreciate it, Justin. And finally, Troy from Marketplace Homes. Mr. Troy Evans, good to see you again.
How's it going, Jeff? It's a pleasure to be here with you I'm excited for this afternoon or morning, wherever you're at in the country. Like you said, my name is Troy Evans. I am the Director of Investor Services here at Marketplace Homes. We handle things from a national brokerage standpoint. I'm helping people buy one-off homes and or finding their new construction homes, as well as managing around 6,000 single family and build for rent mixed together assets throughout the country, anywhere where anybody would want to invest. So glad to be part of the conversation and see what value we can bring to this.
Love it, Troy. And finally, once again, folks, my name is Jeffrey Tesh. I am the CEO of RCN Capital. Happy to be here moderating again as a super panel with really in-depth experts. And with that said, it is truly a treat, Brad, to have you on board, bringing us some data, and data really drives the decisions in our marketplace today. So I'm going to kick it to you, and we'll start off with a few slides on what you're seeing in the marketplace. Take it away, Brad.
Well, thank you very much. Hopefully you can see my slides now. So the opportunity is massive. The demand is absolutely incredible, and supply just can't catch up. These built for rent developments all around the country, we've studied hundreds of them around the country now, and they are all leasing up as fast as they can be built. Part of the demand equation is the millennials, which are forming families finally. The millennials got started forming families 10 years later than past generations, but now the oldest millennials are behaving just like Generation X did and the baby boomers did. They're having children and getting married even at about the same rate. So all of that means the drivers are very clear. The millennial bulge has only begun to hit family formation age. What we're seeing is a huge increase in population coming between ages of 27 and 31, and that is exactly when people tend to want a built for rent single family home, and we're going to see a big surge in that demand over the next 5 years. But It's not just the millennials and young families. It's also people that are going through a life transition, such as divorce. It's also people who have dogs that, you know, if you live in an apartment building, you have to walk the dog, you have to put them on the leash, go down the hallway, down stairs or elevator. If you're in a detached unit or a townhome even, you can let them out the back. It's a lot simpler. They're really being attracted to this kind of product, this kind of community. 55 plus, we're seeing a lot of communities that are targeting that demographic with build for rent, and renters by choice. That's a big part of this whole equation. People who could afford to buy a home if they wanted to are choosing instead to rent. Renter incomes are rising 10 to 12% a year, which leads me to my forecast of built for rent nationwide. I won't take the time to go through how I arrived at these numbers, but offline, if anybody has questions, I went through an hour-long keynote yesterday on the subject of you know, including these numbers. But I think that last year we started about 95,000 homes for rent of all types of build for rent. Now, most of the articles you read won't say that number, and they are not correct. The number is much higher than the 45,000 to 50,000 that is being talked about in 99% of the articles and other presentations that are out there. That is not the right number. It is right around 100,000. And like I said, I can back that up. 2022, this year, we're looking at 110 to 120,000 starts of build for rent. Next year it'll be 135,000 in my forecast. It goes to 150,000, finally gets to 160, 180,000, and there will still be room to grow because we will still be chasing the demand. My last slide before I turn it back over to the rest of the group has to do with segmentation. And this is really just going to be a great backdrop for the next few minutes of this discussion. These are some of the types of communities that we have studied and found to be successful. Single family detached, suburban townhomes. By the way, I didn't put a separate line here for duplexes and triplexes and quads, but of course those work extremely well too. I just kind of grouped them in under infill and suburban townhomes. Horizontal apartments, otherwise known as cottages, or in Florida called casitas. Small detached homes that can be as narrow as 22 feet wide, but still detached homes. Manufactured home communities for rent. These are the different types of communities. And so a perfect BFR portfolio will include a mix of these. And you should think about who your audience is, who your tenants are going to be for each type of product. So with that, I will pause and let the rest of the panel discuss this.
Sure. Let me kick it off, Brad. So segmentation is so important for investors across the United States attempting to build out the perfect portfolio. In your predictions, do you have any sort of idea on what those buckets are going to look like year to year, and how they will get filled up over the next 4 or 5 years in the different segments?
Sorry, who are you asking?
Brad,
You're asking, okay. Well, I think that there is going to be strong growth in all of the segments. And like I said, you have to go back to who the renters are. We are seeing these young families forming. Oftentimes they are renting because they can't afford to buy a home, but sometimes they simply prefer the lifestyle. So as you kind of think about these different buckets, I think that they're all going to grow somewhat in tandem. You're going to continue to see a lot of growth. Probably the highest percentage growth will be in that horizontal multifamily because it's just a new product that's just getting started. I think we're going to see probably the fastest growth in that type of community, but I think that we'll see very, very strong growth in the more traditional types of townhomes and single family detached homes as well.
And before I kick it over to Mark, I'm going to follow up with that exact question. Brad, you had mentioned that quite a few of the predictions out there are really underestimating what you're seeing. Why do you think that is? Why is there such a variance?
So the main thing is the census reports some data that they call housing starts by purpose or stated purpose. And so what happens is those only include, just by the way the census gathers the data, that only includes units that are built by a builder and then held in their own portfolio for rent. Those of us in this virtual room know that that is not the entire picture, because a lot of the units are being built by a builder for sale to someone else who's then going to put them in their rental pool and rent them out or rent out the entire subdivision. So I've made an adjustment for that additional group, and I've got some data from NAHB that suggests that that is at least 3 to 4% of single family starts, which would be 30 to 40,000. So you add the 50,000 that's stated in the census number, add another 30, 40,000, you're at 90,000 very quickly. And I think also a lot of the data gathering completely misses the horizontal multifamily component, because is that single family? Kind of. Is it multifamily? Sort of. So it's this weird hybrid, and they don't know how to characterize it in the data. So I think last year was 100,000, and it goes up from here.
Super interesting. So Mark, SVN SFRhub, right? You're the gold standard in aggregating sales across the United States, boots on the ground, virtually everywhere. You're seeing the segmentation occur. What are your thoughts on segmentation and how that plays out for the localized investor who's trying to build out their portfolio?
Yeah, we definitely see a lot of the segmentation. We see it across most of the primary markets for build for rent. I think for an individual investor, it really comes down to scale. If someone only wants to buy a couple of houses, but they want new ones, then obviously they're going to be in the scattered lot, kind of contingent on that. If they want to look at a larger scale portfolio, then I think it really comes into what is their exit strategy, what resident are they targeting, and what would balance out their portfolio, because we've seen expensive infill townhome projects make a huge amount of sense. We've seen townhome projects out a couple steps beyond the suburbs that I would say are going to be a challenge, just from the standpoint they're pioneering a product type in that area, meaning townhomes, and they're pioneering a use being built for rent. I usually, if someone's pioneering one step at a time, that's probably a good way to go. And then I think it's, if a larger investor or an individual investor is coming in from multifamily, the horizontal built for rent, the cottages, makes a lot of sense, because it's extremely similar. It's the same basic size units for the most part. It's the same resident base, a lot of the same fees and all of that. It's conceptually easier for most of them to understand.
Interesting. Now, Mark, when investors come to you, what kind of questions are they asking when it comes to segmentation, and what kind of data are you providing them to help them make that intelligent decision?
Yeah, a lot of it comes down, if a group is focused on a MSA, it obviously narrows the scope down. Then we have a good idea of who's building what and what's going on in the market. If, say, the whole Sunshine Smile is their market, then we start to really dig into what are their expectations, what are their hold strategies. And as for data, companies like Brad's are an excellent way to gather real data, because build for rent's been around for as long as they've been building houses, but the institutional nature of build for rent is only 4 or 5 years old. So the level of data that a big multifamily private equity group is used to trade garden style Class A apartment, it just doesn't exist. The comps aren't there on trades because they haven't traded yet. As Brad pointed out, the market is that we can kind of guess at it and triangulate in, but it's a lot harder to go into the county records and search every house and decide, all right, this group was obviously a build for rent because it went from a builder to a LLC, as opposed to here's the multifamily project, we can track that through from zoning on forward. It's a lot harder to track these right now.
Yeah. And that's a great segue, Justin, into how investors are thinking about segmentation and financing and how that all plays together. As a lender, how are you folks looking at it and using those comps or no comps? And, how are you folks making the pot of soup over there?
Yeah, absolutely. I think Mark really hit the nail on the head, right? I think for us, when we're working with operators to try to help them scale, first and foremost, we want to understand their business strategy and the markets they want to operate in, and ensure that the proposed projects that they're going with really conform to that MSA and that submarket, right? If you're focused on multifamily, you can't plug a multifamily everywhere throughout the country. Rather, it's very specific to certain marketplaces, right? So for us, we really preach diversity, right? We try to preach that variety to a portfolio to help hedge against the ups and downs that we're going to experience over the next 1 year, 5 year, 10 year, and really get to know what that strategy looks like and trying to best align it with the market they're operating in. And it's important to understand the length of their strategy, right? And the amount of exposure they're looking to take on, as that can really help us hit yield targets and really ultimately scale them to where they want to be.
Yeah, that makes a ton of sense. And Troy, you're in a diverse marketplace. How are you deciding what makes sense from a product standpoint, whether you're holding it or managing it? How's it all working for you, Troy?
It seems that we may all be telling the same people the same things at various steps of their transaction, right? I think Mark put this perfectly when he was talking about townhomes outside of the suburbs where they're also trying build for rent at the same time. And for example, we have one in Georgia where people are used to land, but we manage a 100-unit townhome community there. It's a little bit different. These are typically people coming from multifamily. So as we are having these exploratory conversations, it always does come up with, who's the resident that's going to be looking here? What do they expect? What do they want? We may have another phase. What do you think we should do with that based on your internal data? And it's always about taking what we know residents are looking for from our one-off individual homeowners to our other institutional clients as they're coming through, feedback, local knowledge of the market, maintenance, so on, to say these are going to be the needs that people want. A mobile community outside of Tampa is going to work a little bit better than somewhere right in Atlanta, and we know that. So as we're having these exploratory conversations and next steps, we're able to take knowledge from the residents, knowledge from our own homes, knowledge from others' homes, and come up with a game plan for them, and hopefully reiterate the same thing that Justin, Mark, Brad, or anybody who's talking to these groups have already said, and back it up with what we're seeing on the ground.
So you mentioned something interesting there, which was possibly pivoting on phases of developments. And I think for especially newer investors coming in to this space, the option to be able to pivot on the segmentation inside of the same development could really pay big dividends if, number one, there's opportunities that crop up down the road that you didn't think about. Maybe talk about that a little bit and whether that is something easily achievable or how do investors look at it?
How easy that is, it all depends on how the development's going. There are some where we're in, and I would say this is probably 70 home plus communities. Mark can probably correct me if I'm wrong, where they're going to break it up in phases. There's probably going to be a 5 to 6 month difference between those two phases. And as they are going into finalizing, what's going to be built and in what size, and I think this is easier with townhomes, we were able to say, 3 and 2 bedrooms are great, but people want 4 bedrooms, right? People are working from home, they want offices, all of these things. Can you do less 2s, maybe do some 4 bedrooms and some more 3s, and that's okay to do. How easy that is, like I said, I have no idea, but you're able to take the data on the ground, maybe and get a higher rent return on it, and hopefully your days on market goes down because you're giving the community exactly what they're asking for.
So I think that's super interesting for investors today on our call, which is thinking about forward opportunities other than what you've already outlined in your initial phase development plans. I'll open this up to the entire group. Are there any best practices when we start to think about phases and changing up your model allocation, whether it be segmentation of the asset or the internal workings of that asset, bedrooms, and what it looks like? Are there any best practices that we can share with our investors today?
Yeah, I think when we look at multi-phase projects, usually we're looking at them with the developer or builder. If we know that, say, phase one is going to be townhome and phase two is going to be single family detached, then we can segment out kind of square footage, bed bath count, so there's not a huge amount of overlap. And then thinking an eventual exit as part of this is really structuring the HOA and the subdivision so you have basically two distinct communities that could live separately, because some investors only want 3, 4, and 5 bedroom single family detached, and others love townhomes. And the more optionality there is within that, the easier the eventual sale is, which will be for more money. But if it's even, say, a larger single family detached community, let's say 150, 200 units, where build out is going to take a while. And let's assume the supply chain actually corrects itself and you can get garage doors. Is if the investor is really engaged with their property manager and talking to them, and the property manager is keeping track of what prospective residents are looking for, well, you can call an audible after 50 houses. If everyone's looking for 4-bed and you scheduled mostly 3-bed, well, now you can start building 4 because it's the same lot, it's the same approvals, you're just putting a different house on. So really being engaged with the local market and your property manager like Troy, it can pay huge dividends, because a little bit of tweaking early on results in massive potential upside valuations.
And
Yeah,
I'll
I
just
mean,
I'd like to add that I think this is going to become more and more of a relevant question over the next year or two, because I'm seeing a shift in the sizes of built for rent communities. 12, 24 months ago, they tended to be 60, 70, 80 units total in the built for rent community. Now, more like 100 to 120. I think that it's probably, headed by later this year or into next year, 200. We're seeing a lot of developments in the 200 plus range, some even 300 units in a single built for rent complex. So the difficulty comes with, well, how do we think about after those turnovers begin? And now, granted, these are sticky tenants; they don't tend to move out within a year or two, but you do want to try to minimize any kind of cross competition with your first year or first 2-year, first 3-year turnovers. So I think that's going to be really important to continue to focus on phasing.
Makes a ton of sense. With that said, Brad, I'm sorry, Mr. Parker.
No, I was just going to say, I mean, I think Mark and Brad are making great points here. I think it's actually a really good thing to be able to pivot throughout these projects and adjust floor plans along the way as you're assessing demand. I think the big thing to reiterate is to have that communication and define key partners throughout the way that you're working with, to talk that through and to be very clear about what you're seeing and how you want to adjust, so you can make sure that in the next year, 2 years, 3 years of development, you have that flexibility to adjust on a dime and be able to take advantage of that demand that you might not be tapping into day one.
Yeah, absolutely. Makes a ton of sense. Brad, I'm going to kick it to you for the next segment of slides, please.
Okay. I'll go ahead and have to reshare. Let's see, press that. And so what I want to talk about next, and by the way, just to kind of catch up on a couple of things we just talked about, definitely being able to pivot your product as you go to subsequent phases, that's going to be a great way to reduce risk. And that segues into my next topic for us this morning or this afternoon, which is risks and how to think about them and how to mitigate them. One of the risks that gets brought up a lot is the depth of market. And I will remind everyone that all of those 100,000 units that got built or started last year, those that are getting completed by now, are getting absorbed very rapidly, as fast as they can be completed. And I think there's going to be room to increase rents going forward. But the point I want to make here is that you get to pick where you want to live on the BFR risk spectrum that I've created here. So the vertical axis you see is market or project risk, and then the horizontal axis is land risk. So you can decide, do you want to be involved in the land side, Or do you want to just build for fee and sell to someone that's going to hold the property? And you know, if you're a builder and you can just build under a forward contract where you know exactly what minimum price you're going to get for the homes you build and how fast they're going to be taken down, you don't have the risk that you normally have as a builder from the market standpoint. You still have cost risk, which we can talk about, but that's another topic. So going up this axis on the up and down, you got the tried and true submarket, you got the submarket that's not perfect but pretty solid, average potential, pioneering markets, and then hairy. And then on the land risk, you start with build for fee, where it's C of O, you don't have any risk if you're the builder. Land participation, entitled land, finished lots, and then the most risky being raw land. So about 70% of the deals that I'm looking at are in this category of the kind of C of O build for fee deals, but we also do a lot of studies for folks that are living out here on this side of the risk spectrum where they're holding land. And of course, you want to avoid having high project risk, market risk, and a large raw or finished lot position. So you want to be kind of in that lower portion of the spectrum, but you get to choose exactly where you want to be. And a lot of our clients are really kind of just looking for entitled land or finished lots, some of them going for raw land as well. And when you think about how to mitigate your demand risk, you do want to model both types of demand. Here's an example from an actual study we did where we said, okay, we're going to look at demand coming from new households that are being formed in the area, that's the submarket, or what we call the PMA, primary market area, and also the move-ups. Move-ups is that segment of demand from people that are already households in the area. They already live there, but they're living in apartments. And how many of them can we get to move up to a townhome or a single-family detached or cottage type product? You have to model both of those. Now, how we forecast rents. This is another way to kind of mitigate your risk with regard to the market. If you are taking market risk, which a lot of folks on this call probably are. So the way we look at it is we use a 4-spoke methodology. So we look at SFR rents. We have to make adjustments because of the age and quality of the units, plus there's always a premium above SFR that you can get with BFR because you're going to have a cohesive community and professional management, and don't have to worry when the washer dryer breaks if the landlord is out of town. BFR comps, if there are any, and in 50% of the studies we do, there aren't any, so we have to rely on these other aspects to triangulate. We look at the multifamily comps, of course, primarily focused on the 3 bedrooms if it's a detached or townhome unit, but the cottage units tend to also reflect competition from the 1 bedrooms. And then we look at the for sale market. What is the cost of ownership if somebody buys a home that's relatively new or brand new in that submarket? And we look at not only the PITI and HOA fees and CDD or other taxing district fees, but also the cost of maintenance. And then we combine that with surveys of our renters. So, and I'm telling you this, not you can do a lot of this research yourself. If you don't need that third party sort of branded study, you can do a lot of this yourself. What we like to do is put it in a structure we call the RPM, which is the rent positioning matrix. And what we do is we take for each bedroom type. So these are 3 bedrooms. This is from an actual study we did. That happened to be in the Minneapolis-St. Paul area, which surprisingly has very strong rents. We're seeing rents in some of the built for rent communities of $3,500 a month or more. And you can see that on this graph. And we label and analyze and adjust each of the key comparables so that we can kind of arrive at where the subject rents can come in. And then we overlay data that we collect from our own surveys. We create demand curves out of the data so we can say, what is the premium for a built for rent community over apartments? How much more would somebody pay above what they're paying right now for their suburban apartment to live in a townhome or a single family detached home in a purpose-built BFR community? So here, for example, if you take that orange line, that's the people that earn between $70,000 and $90,000 a year. 50% of them would pay $250 more than what they're paying currently for rent on a monthly basis in order to have a single family home in in a purpose-built, professionally managed community. So these are just some of the ways that you can look at data in order to minimize your risk in the market. With that, I'll turn it back over to Jeff and the panel.
Sure, Brad. So quick follow-up. How have you been adjusting your data to the tremendous spike that we've seen in rents over the last 12 to 18 months? How's the lay of the land looking there?
You know, that's one of the advantages that we have with our backgrounds as economists and demographers. We're used to looking at things on a future basis and projecting into the future. And what we can see too is looking at those incomes of the renters and incomes of the millennials as they've progressed in their careers in the last 10, 15 years. We're seeing them making more money, and they're able to pay higher rents. So we do take we look at the data as we arrive at it from that four-spoke model and so on. And then we say, here's what the rent would be today. And now here's projecting forward what we think the rent will be when your project opens, and then maybe even a year after opening. So it's important to be dynamic that way.
Yeah, it makes a ton of sense. And Troy, you know, risk, demand, eventually you end up with the rent. When you're working with your different investors or even internally for your own portfolios, how do you folks really rationalize that risk and demand? And at the end of the day, how do you make the call?
Again, I'm a huge fan of, I'm gonna reword this. Just like any company, I like to look at exactly what the customers are saying. And in this case, not only are the owners our customers or these groups, but so are the residents. They are the customer of the owner. So how do we take the feedback and the knowledge of this person who wants to come in and reiterate that back to the owners? You know, what rents are too high, right? Were they overvaluing these models, which can be the case. A lot of times it may be because they're doing them themselves and not a professional third party, but that's something to look at. But then how do we pivot away from that to mitigate the rent loss risk and what you're going to take, and maybe just be more creative with it? There are common residential tools that are becoming very popular in the single family and build for rent space to give residents access to new worlds that we haven't seen that are going to make them want to pay a higher rent. Security deposit replacement. That's a very big one. You know, you're not financing it and there's no risk to the owner. So how do we utilize that to keep the same rents or higher to save somebody on move-in fees? You know, you have credit reporting, which is becoming, which I think is becoming very big as far as rent payments go, because you're getting the positive outlook that a owner who's paying all their mortgage payments on time is getting on their credit report. A resident can get by paying their rent on time. You know, groups like Suzu are doing that, which I think they're a great company if anybody hasn't talked to them, to help drive value to the residents. So in my mind, how are we going to take what the resident sees as value in the home, and if they're seeing a lower value in it, how are we going to drive that up without having to lower rents in returns for the investor? And it's being creative with programs, products, things that can save them money and make the owner money at the same time. And I think that that's a big piece that gets missed. So people like to look at rent, what their build cost is going to be. That's the return. How do we get a little bit more creative with it?
Interesting. And, you know, Justin, as a lender at RCN, you're all about risk, right? At the end of the day, you want to make sure that your investors are successful. And I think Brad had some great slides there on data on how investors need to make intelligent decisions. How do you work with investors to be able to use that data to make sure that they are making the intelligent decisions when they end up choosing product type, location, and what those rents are going to eventually end up being?
Yeah, absolutely. I was trying not to interrupt Brad when he was going through it because I was so excited to see what he was presenting there. You know, I think it was mentioned earlier in the call that, you know, this build to rent has been around forever, but it really hasn't been industrialized, if you will, until as of recent, right? And one of the great things that comes with that is this drastic amount of data that started to flow into our space that allows us to make lending decisions and really partner with operators to guide them through the process, right? I think when you're looking at the average rents, right? You look at a 14% pop that we saw in December of 2021. What does that look like over the next year, 2 years, 3 years? And how does that play into your project and the phases that you're going through? And is it going to yield results, right? Is it going to hit that yield target as an operator that you're looking for? You look at HPA and interest rates rising and what that's going to cause for affordability issues. How do you adjust, right? Do you need to pivot your project to maybe produce a property that's a different floor plan that gets an extra $500 in rent a month to compensate for what that yield's going to be down the road? And really trying to culminate all of that different information and data and apply it to that particular scenario. I think everybody on this call today would agree that no one operator has the same plan in mind as another, right? Every project is very different. It's very unique. It has its own business strategy tied to it, its own exit strategy tied to it. And being able to really get to know one another and partner to understand the end goal for each person involved, and then layer in this data is really what drives all of the decisions we make from an underwriting and credit perspective here to identify successful projects.
Yeah. And when investors come to you, do they typically have the plans laid out, or is it more of a work in progress? What do you see from investors, Justin?
Yeah, it's a mixed bag, if I'm being honest. Usually larger scale operators usually have everything pretty tied up with a bow on it and ready to present. We also see a lot of more entry-level investors or operators, as I call it, that have the pieces there but not fully completed. And depending upon what's presented to us, we still approach it the same way, which is identifying the geography that we're in, the MSA that we're in, what they're trying to achieve, put together our interpretation of the data within that marketplace and really talk it through, right? Try to understand and get out of them what that end goal is, and then craft a loan, craft a strategy and a time frame that has the flexibility to adapt as they continue to adapt. So it's not, everybody's not fully prepared when they approach. They have a general framework of what they want, and then it evolves as time progresses.
All right, and that's a great segue to you, Mark, which is, the risk, the demand, the rents. You're seeing it across all geographies across the U.S. What are investors saying to you when they come to you and they're, hitting these data points that Brad spoke about, and how do you get them to a place to be able to make that decision?
Yeah, getting them to a point to accept that it has been a challenge. And we've been working with Brad for a while now on some of those studies, and the willingness to pay above the multifamily rents. And it's important to note we have a lot of builders and investors who will look at multifamily per square foot and then try to correlate that to or build for rent per square foot. Well, a 650 square foot one bed apartment is a fundamentally different rent profile than a 4-bed 1,800 square foot house. And until the current kind of group of build for rent whole projects started coming online with actual verifiable rents, it was very hard to get investment committees or some of the larger investors to accept the level of premium that we knew existed. But now with studies like Brad's, we can start to show, I'm a broker, I'm inherently untrustworthy in a lot of people's eyes if I'm trying to simultaneously sell them a project. So we can show them these studies. And now in certain areas, especially say Metro Houston and parts of Florida, we can look at what the SFR rents would predict and what apartment rents would predict for an area. And then we can now see a build for rent project 5 miles down the road, and they're 20, 30, 40% higher in rents on some of these. But now we have real comps to get them through that. But a large part of the country, there are not whole communities of build for rent that exist that are actively being leased, especially that have turned over to be able to show solid comps.
Yeah, and I think, and Brad, I'll pivot back to you. I think as the data becomes more mature, it's certainly going to make as lender decisions, investor decisions, much more cohesive to be able to make these decisions, I would think, in an expedited way.
Yeah, no, that's right. And so we're hearing more and more people asking questions like, well, with $50 billion or 30 billion or 60 billion, depending on who you want to listen to as to how much money is flowing into this space, a lot of people are saying, hey, this sounds like a lot. Are we overdoing it? And what you have to do is put those numbers into perspective too. And not all of that money is equity. All right, a lot of it is kind of this amorphous joint venture, committed funds and things like that. How much of that committed money is going to get deployed this year versus next year? It's going to be spread out. And even if it's the top number that I've heard, which is 75 billion, and I'm pretty sure that's speculation rather than anything that's already been announced. And if you consider that not all of that is equity, then it's probably about a 1.5 year supply worth of BFR product, which is based on my forecast. So that's why it's not worrisome. I think that there's still a situation where for years now we're going to continue to chase the demand, and we need to increase the supply production. I don't know if I answered your question, or I kind of went off on a little bit of a tangent, but I think that was
100%. I think that's good info for the investors today, because it's really what they need to think about, longer term to make those decisions. And I will stick with you, and you can go to your next segment of slides, please.
Okay. I need somebody to turn okay, here we go. All right, so this next few slides is really just continuing on that subject of how we think about rents and addressing risks. And so this is a few pages from some actual studies we've done. So this gives you a sense of how we quantify who the subject renter is going to be for a particular subject site, for a particular product type. So we use Tapestry segmentation, which is a psychographic system that is very sophisticated for figuring out, who are these people and what kind of lifestyle do they have? And then we translate that into what we call the expected renters for the subject property. So what we have to bear in mind is that, and by the way, there's a lot of NIMBY risk, right? So some of these developments, if you haven't gotten approvals yet, local governments are kind of standing in your way in some cases, saying, hey, we don't want more renters in our community. But these are not riffraff. That's the lesson we need to impart to these local decision makers. Mostly, the millennials here in this example, we're going to be making $100,000, $80,000 to $100,000 a year. We're seeing a lot of communities that are built for rent where the renters are making $120,000, $140,000 a year. So you have to look at it from that standpoint. And remember too, it's not just nuclear families. It can be divorced people, it can be singles, depending on the product. So here's another way we kind of segment it and look at it for, again, from a sample study of ours. And then we also look at another aspect of risk, which is there enough shopping nearby? As developments start to get developed farther and farther from the urban core, you have to make sure that there's a grocery store or two and drugstore, convenience store nearby. And you also want to look at the pipeline of supply. This is something that we're getting from a lot of the financial firms that are backing these projects. They're asking us, how can we quantify the supply pipeline? So this is kind of the way we address that in our studies. Another sample page from a study that we did, and another one where we look at, again, at the rent risk. How do we think about what the ceiling is for what the rents can be? And again, we compare with the cost to own. So we look at subdivisions where builders are building and selling homes in that particular submarket. So the blue bars here in this case show you the monthly cost of ownership versus the sort of red horizontal band that shows the rents that we were recommending in that particular study. And so again, just to wrap up my comments, the risks are primarily because there may not be comps. And Justin and Jeff were both talking about that a few minutes ago. And again, a lot of our studies are able to come to a conclusion without actual BFR comps. And that's important to be able to kind of look at it from a a data standpoint from triangulating, some people call it, but I call it more like quadrangulating because we're looking at more than 3 different inputs to come up with these conclusions. So with that, I'll go ahead and turn it back over to you, Jeff, and you can go ahead and finish up and close out my slideshow.
Sure. So this is an area that I'm excited to get to, which is geography. When investors are making decisions, especially we'll call them moderate to more sophisticated investors who have a wide breadth of ability to be able to invest either through existing or new build for rent options across the United States. What are some best practices on how investors should be thinking about geography, especially as it pertains to the data that you're seeing?
Yeah, you definitely want to make sure that you have a certain drive time to jobs. It doesn't have to be the urban core or a downtown per se. You know, we just did a build for rent study for a site near the Woodlands in Houston. And, you know, when I started my career 35 years ago, you know, that part of the world was definitely a commuter market coming into Houston. That was a long commute. And now that's the job center. So you need to be near a job center. You need to be near shopping. You need to have decent schools, but we're finding that the market is actually pretty tolerant of average or even slightly below average schools, depending on the product type. And, you know, obviously as you go to the cottage product, that's less of a family product than the 4-bedroom houses and so on. So that has a bearing on how important the schools are. But, you know, the drive time to jobs is important, even in the world of work from home and work from anywhere. I do think that there will be this continued migration out of New York and into Florida and into the Carolinas and out of California and into Utah and Colorado and Texas. And I think that will be sustained. Some people say, hey, you know, after COVID, maybe that all comes to a halt. I don't think so. I think that those were trends that were already happening before the pandemic, and I think they will persist for a long time after that.
Yeah, that's very well said. And Mark, I imagine geography is a huge question for you, looking at the various portfolios on your platform, whether it be existing or potential platforms. Just even from a 30,000-foot view, when an investor comes to you and says, all right, I'm ready to get into this space, I don't know where I want to go. How do you have that conversation with them?
Yeah, it's frequently a tricky conversation. And then two of the big drivers to me are, what is their exit strategy? Because we've been talking a lot about resident demand. There has to be a corresponding investor and equity demand. So if they're going to be fee building or paying a builder to fee build and they're not using their own equity, they have to be able to raise the equity. And if they aren't lifetime multi-generational holders, they're going to want to sell this at some time. So we get into a lot of the real small areas have unbelievable demand, resident demand, because there haven't even been market rate apartments built in 20 or 30 years. What there isn't, though, in those markets, partly because build for rent is so new, is the investor demand. So then we have to talk about kind of that strategy. And then I'd say it's also scale. Is how many houses in an area can someone acquire? You know, if you're working with someone like Troy, you can go from market to market. If you're going to attempt to self-manage, which if you haven't done, I would recommend talking to a third party, but you can scale quicker and you can utilize their scale in a market to buy a smaller portfolio and maybe buy a couple smaller portfolios in multiple markets to hedge your risk kind of thing. But if all of a sudden you want to take on all the lease up and you want to manage that and you want to have good control of subcontractors, so if the toilet starts leaking at 2 in the morning and you're not going to be the one to go out there, you have to know who to call. Well, if you only have 3 houses in a metro, that's going to be a challenge. Whereas, you know, a good property manager, they might already have 1,000 houses that are owned by 200 people, but you still have the benefit of that scale. So that's some of what we go. And then it's, if their exit strategy is purely to a big institutional known group, then it's a whole different set of markets. It has to be the big ones. If they're willing to sit in it longer and sell down kind of the level of scale, then you can start branching into secondary, tertiary markets, I think safer.
And Troy, I'm going to ask you the same question, but with a little different flex on it, which is when that investor comes to you and they want to understand geography and they say to you, hey, I want to build something that I can earn income off for my lifetime, but I'm looking to hold this long term. How do you have that conversation from a geography perspective? And they've got to, whether it be a moderate amount of money or a boatload of money, and they're coming in, how do you get that conversation going with folks?
You know, it's funny because usually they're the ones who bring it up first, right? The idea, and I believe you said it at the beginning of this, was generational wealth. If that's somebody's goal, it is always the first thing that they talk about, whether it's a family office, whether it's just somebody who, you know, has made a good amount of money in Google, and they're looking to set it up. They're always the ones to bring it to attention. And to be honest, from a property management point of view, that doesn't change a whole lot for us. You know, as you get years and years down the road, you know, your costs to during your turns, those start to add up. Those start to get a little bit longer, especially as more build friends probably going to be coming to the same area upon the success of this one, you know, what your competition is. But it doesn't change a whole lot from a day-to-day for us. Just like Mark said, we also ask up front what their disposition strategy is. It's a very important part of how, you know, things start to progress, and we talk to them on a weekly, daily basis. Questions come up. How should we structure our HOAs if we're going to rewrite it? You know, how should we do all these little things that all go back to the same advice of, you know, if you're doing regular build for rent, single family and townhomes, you know, do you want to separate those different HOAs, different disposition strategies, all of those different things. So I don't think that the hold time affects anything on our side. It's just about how can we know what their strategy is from the beginning, or as that adjusts, to be able to make sure that these are operating in a way that are going to be easy to dispose of or not. You know, let's focus on 36-month residents if you want, with no rent increases, because you don't need to worry about what somebody's going to look at on the books. It's actually funny because we have a build for rent community in Birmingham, Alabama, where they wanted us to charge them more like multifamily pricing, because it would be more interesting to somebody who's going to buy it because that's what they're used to. Okay, we're not going to say no to charging you more. I mean, that's fine, but you don't have to, right? So it's interesting conversations like that come up. And I expect as this becomes more of a commonplace, and I'm using that in air quotes because it's still early, that somebody's going to have an idea of how this build for rent market's going to work, and they're going to not want us to charge them more for somebody who's going to want to buy it. Those types of things.
Right, and to you, Justin, geography, right? Like, I imagine that when customers come to RCN for financing, geography is a big part of it, and eventually that strategy, to Mark's point, are you going to hold it long term? What's your exit strategy? Do you need to pull equity out? Are you going to keep equity in? It's got to be various data points that you look at.
Yeah, I think, you know, it's been summed up pretty well. There's a handful of things that we really look to focus on, right? Population density and demographics are important to understand what you're building and how you're building it. Do you have to drive an hour into town to go to the grocery store, or is it just down the street, right? I mean, that's going to dictate a lot of the price point of what you're looking for. But, and Brad, I think you alluded to it, one of the most important things that, you know, hasn't been talked about much, but is really a deciding factor in a lot of projects that we see, is understanding your local municipality and those decision makers, and how hard it's going to be to get those approvals for those permits and plans, et cetera, to do what you want to do for that corresponding area. It's amazing to see how much disruption there is from people wanting to prevent renters from absorbing the marketplace, right? And you see a lot of pushback from these municipalities to do that. So, you know, it's important from an operator's perspective, and us as a lender where we see it on numerous occasions in different municipalities, to understand what kind of hurdles you're going to have to go through. And adjust your project timeline to that, right? So if you know that it's going to be more difficult in a certain MSA to get these approvals in place, you want to make sure you build out a timeline for that geography and for that loan and et cetera, that fits that delay that you're inevitably going to expect. So that's a really, really important piece to this that I think is important to note on the front end in terms of how you're assessing and putting your project together.
Yeah. And we're coming up on the top of the hour here. We're just about out of time, but there's one question that I really wanted to get to today. So I'm going to throw it out to you, Brad, and maybe we could rapid fire it around. But purpose-built, built for rent communities versus scattered built for rent, meaning infill lots around. And I'm sure, Mark, you see this in your portfolios. But Brad, is there data on that, on what investors should think about?
Sure. And by the way, the political aspect of that is interesting. When you talk about buying existing single family homes, that's where everyone's up in arms saying, hey, you're taking away all the supply for people that would like to own. And the built for rent doesn't suffer from that issue, really, if you state it the right way, because we're building, that's the B in built for rent, right? We're building new homes. But from the standpoint of just operation efficiency, it is absolutely more efficient to operate a community that is a subdivision that's all built for rent as opposed to having scattered. That's probably pretty obvious. I'll let the other panelists chime in.
Mark?
Yeah, I agree. A lot of it's the efficiency of operating and managing the units. If you have 20, 50, 100 houses right here, it's a whole lot easier than if you have them scattered around the outside of Metro Phoenix, Metro Atlanta, whether you're managing or someone else is managing. And then I think you can start getting into, again, what's the exit strategy? Do you want to be able to sell them one-off? Start looking at what the HOA requirements and regulations are if you're buying scattered homes, because you don't want someone to all of a sudden kind of say, we're tired of renters, we're just going to outlaw, or not outlaw, but prohibit that from our community. Whereas if you control it all, you're probably not going to vote yourself out of that community.
So that's an interesting thought, right? And we can't go down, we're going to run out of time, but for investors who end up buying portfolios of scattered sites that are existing already, there is an exit strategy to be able to pull cash out by taking those infill lots and being able to sell them. Do you see that, or how does that work, Mark?
What we definitely do on the scattered home portfolios, especially if someone has 100 houses, that's a lot of brain damage to start peeling those off and evicting or waiting for the leases to expire, bringing them up to kind of market ready because they've probably been somewhat beat up if the tenant's been there a long time just from normal wear and tear. If it's a whole community, while that optionality exists, it becomes so much less efficient because now you have to put the HOA fees in, your financing might change, and just everything starts to evaporate until you only own a couple of them. So it's definitely more a strategy for some of the scattered portfolios, I think, than the whole communities.
Yeah, so that's certainly something for the investors on the call to think about today, right? Your long-term strategy. If you're thinking about pulling cash back out of your portfolio in X number of years, the type of portfolio that you aggregate can go a long way in your ease of use to be able to do that. Troy, purpose-built versus scattered, thoughts on that?
While our management structure and process is the same on both, what we hear from the infills is competition with the sales reps in some of these new construction neighborhoods. They don't want to sell to investors. They may not be able to. They may not want to. It all depends. So there is a little bit of a barrier to entry in those types of markets. Now, what we've seen from more regional builders are side lots, in certain areas where somebody's house next door was built in the 60s, and they want to build this one there. That's not everybody's cup of tea. But again, something to think about. They're not every piece of land is a piece of land you're going to want to build on. It may look off. You may not have the resident density to make it work. So those are the two things I see with infills that are kind of on my con list compared to some density there.
Sure. And Justin, we'll finish up with you with that question as well.
Yeah, I mean, I obviously agree. I think especially when you look to scale out a portfolio, just the amount of operational efficiency that exists there is, I echo the thoughts of Brad, Mark, and Troy here. The only thing that I would say about infill, it is a very competitive marketplace and it's certainly higher barrier of entry, but we do have a very aged housing inventory in the United States. So there are a lot of opportunities that do exist in those infill-like projects. It's a great way to get started and get things rolling, but as your portfolio continues to grow and grow, I do think it is harder to manage and create those operational efficiencies by growing a portfolio with only infill. But I do think that there is a unique opportunity there as a starting point for many people looking to get into the business.
No
Yeah,
doubt.
well said. So, folks, we're going to have to leave it there today. Thank you so much, Mark, Brad, Justin, Troy. A ton of data. I feel like we could go on for hours here. Investors, I hope you got a ton out of this today. Across America, this is a burgeoning market. We're seeing it at RCN. Our partners at SVN, SFRhub. Certainly, Brad, thank you so much for the data. Troy, Marketplace Homes, you guys are killing it out there. Until next time, I look forward to seeing you all again very, very soon. Once again, Jeffrey Tesh, pleasure, pleasure, pleasure. Thank you so much.
Thank you, Jeff. Thank you, everyone.
See y'all.